You're looking for an absolutely fantastic investment opportunity today, a strong grower, a strong compounder, a company that's going from strength to strength. Let me introduce you to a fantastic company. Not only is it growing strongly, not only is it available at a fantastic price today, but it also pays a dividend, recently started and still growing. Let me get into covering off today Cigna Group. This is a fantastic option. We're going to go over a little bit about the history, about what the company does, about the growth, the margins, what makes it a fabulous investment today, as well as at the end, looking at the likely investment returns from an investment today.
Cigna Group is a fantastic company. It has a very low dividend yield at the moment, and it has a low short interest as well, which tends to mean that people and analysts are going to be fairly bullish on the stock. We can see here the short interest as well, though it did spike at a much higher level in 2018. It's returned to a very manageable under 1% now, which is something I'd like to see generally when I'm long, and I'm going to be long for the long term. Now, Cigna itself has quite a number of subsidiaries, and it primarily relates to insurance and health services. So we've got elements here such as pharmacy benefits, home delivery pharmacy, specialty pharmacy, distribution, etc. Now, they also have quite a lot of insurance contracts as well to corporations, which is also an important part of their overall business mix. So when we can see this, there's a number of really nice things here. So they've got quite a spread of work. They've got exposure to Medicare. They've got exposure to longer term contracts with major corporations, all of which provide some level of stability in terms of their income. Now, this is, of course, a company as well with a very strong history of over 200 years of operation, so it's not a company that I think is going to go away anytime soon. Now, some of the other key points down here are the 5-year sales compound annual growth rate of 33%, which is fantastic. EBITDA 5-year compound annual growth rate of 15%, a net income of a 5-year compound annual growth rate of 21%. So one of the things that I like about Koifin as well on this overview page in the description is it gives me quite a lot of information here. Now, dividend yield of 1.7% has a very reasonable payout ratio here of 20% as well, which would tend to suggest that there's certainly room for the company to begin to increase that dividend with time. Now, when we begin to look at the percentile rank, we can see in terms of their history, generally here, the price to earnings, they're looking pretty good in terms of their history. They're also looking fairly good in terms of percentile rank against the wider US healthcare sector, which is always good to see. Now, the enterprise value in terms of sales, these are very good rankings here as well, which is suggesting, I think, it is a good purchase opportunity at the moment. Now, shareholder yield as well is at 10%. Now, this is a really nice value to see, and again, we can see this is very high in terms of the overall 10-year history for the company, as well as being quite a high shareholder yield in terms of the wider US healthcare sector. Now, another important element as well is whether or not they tend to beat or meet the analyst estimates. And as we can see here, in the last several years, they have had a narrow miss here, and that's quite a narrow miss by most of these figures here. And otherwise, another narrow miss in 2019 and another one in 2016. So generally, most of the time, they beat analyst estimates, and usually by a reasonable amount here as well, of high single digits or into the double digits, which is absolutely fantastic to see. And again, in 2022, again, more beats, and in 2023, again, more beats. Now, I do like to see the analyst estimates as well, and the analysts in Koifin, the Koifin platform has a fantastic way of viewing the analyst estimates and consensus here. In the left columns here, we have the actuals, and then we have the analyst consensus estimates. Now, the sales here estimated to increase percentage-wise about 6% this year, 20% in 2024, and then 5, 6, and 6% into the next several years, which is some fairly steady, good increases here in terms of the overall sales increase. EBITDA increases a bit more moderate here, but again 2%, 10%, 5%, and about 1% going forward. And I also want to scroll down as well to look at the per share data here for the EPS adjusted. and the EPS adjusted 6% this year increase, 14%, then a 12%, then another 9 and 10% into the coming years as well. So for me, I like this. I think this is looking like a very nice opportunity here based on the dividends, based on the analyst estimates. And one of the other important ones as well is this analyst estimate here for the dividends per share, estimated to increase by about 10% this year, then about 2%, 5% and 10% going forward. So we're not talking about a company here which is going to light the world on fire. It's not a company here which is going to be growing the dividend particularly strongly, but it is certainly a company that is going to be growing this dividend as well, and I think a company where we can begin to look at this in terms of the overall growth for the company, and therefore I see this as more of a total return with some income. Now I think here when I look at the growth rates as well, this is important for me, so I want to see these sales, adjusted sales increasing, gross profit increasing, EBITDA increasing, EPS increasing, the adjusted EPS increasing, and so these are all the types of figures, these are all the types of trends that I do like to see. Now overall then, perhaps not unsurprisingly, what we are seeing here is tends to be a buy or a strong buy by most of the analysts. And we can see, as we normally see, the analyst price target is a little bit higher than the current prices. But as we can see here, the current price to the analyst price target, it can vary up to about 40% at times. At the moment, 20% increase on the current price would take us to the price target. It's not the highest level, but it's certainly not one of the lowest levels either, which indicates to me that this is probably quite a nice time to think about taking an entry. Now, one of the other beautiful things about Koifin as a platform is it gives us a strong perspective here on the many of the key metrics, and one of the elements I want to look at here is the overall margins and the returns. Generally, the returns on assets and equity are manageable. We can see here from these bar charts that it has not been the strongest performer in recent years. But certainly when we look at margins as well, they have been shrinking a fair bit here in recent years, which is definitely going to be something to keep an eye on, because that's not the sort of trend that I like to see. Now, one of the reasons for the recent price decreases has been this news here around the Blue Shield California, looking at a new model which would reduce the earnings for Cigna. They have a reasonable exposure to the Californian market. And even though there are some suggestions here that the Blue Shield plan does have some challenges here in terms of execution risks, one of the key elements is that this would cut into the profitability of the Cigna group as well as several other healthcare providers such as CVS. Now I'm switching over to Fast Graphs for a final quick visual check. An important point here as well is they have an S&P credit rating of A-. And if we look down here at the analyst scorecard as well, we can see in the 2-year forward either hit or beat the analyst estimates. And 1 year forward, they very much tend to hit or beat with a few misses, but very much a negligible level. Now when we begin to look at this, I've got the adjusted operating earnings showing, and we can see historically that the company's traded below this orange 15 times price to earnings line. Generally, they've traded at about the 11.8 times PE ratio, which is pretty much where they are today. So I'd say, as a company, they are fairly valued today. Now, if I turn on to the forecasting calculators, now I've got here showing the last 5 years they've tended to trade at 12.7 times. So they're trading a little bit lower than, let's say there's a small margin of safety. Now, back a couple of months ago, there was a large margin of safety where they were trading at a price to earnings ratio of about 10.2 times. But even now, into the 11 times, there is a reasonable opportunity here. Now, assuming that the analyst estimates are relatively accurate, and assuming that the prices return to this 12.72 times, we're looking at a total rate of return of about 50% till the end of 2025, or about a 20% rate of return annually. Now, one of the other important things here on Fast Graphs is it also shows you these analyst revisions over time, and we can see here over the last 6 months the revisions have been slightly upwards for 2023, very stable for 2024, and again very stable also for 2025. which to me suggests a very strong probability, coupled with the analyst scorecard, that they're going to hit these targets here. Now obviously price will sometimes trade higher than this price to earnings level, so it could here for example be up to 14 times, but generally I would say this is a nice safe investment. Now, 3 analysts have also provided a long-term growth, so this is a rough per annum growth in earnings for 5 years, and these analysts have on average suggested about a 10% of increase for the earnings per year. Now that would be a very nice long-term growth. Now one final point here as well is the dividends have been increasing. Again, this is not going to light the world on fire in terms of the overall dividend level, but certainly a slow and steady increase, and a starting yield now of about 1.8% is certainly not to be sneezed at.
So what do you think about the Koifin platform? Let me know in the comments down below. If you are interested in giving it a trial, please do use the link down below. I will get a small affiliate commission for you using that link and buying through the link, and that commission will help support this channel and help support me to get more interesting content out here for you. Let me know what you think. Is Cigna on your watch list, or does it overlap too much with other investments that you've already got? Now, obviously you want to remain diversified. If you've got a lot of other healthcare related stocks, this may not be the stock for you. And yes, it's not trading at deep value, but it's also a reliable, strong-term grower and dividend compounder. I think so. This is going to be a wonderful opportunity to get in now before the growth continues and the price could really begin to take off from here. What do you think? Let me know in the comments down below, and hit that subscribe button, hit the like button so I can get this video out and help some more people. Stick with me, and I'll see you soon.